So once again, thank you for joining us. I do want to just quickly acknowledge the panel members, just to confirm that you can hear me as well. Dio Onyango, please confirm if you can hear me clearly.
Good morning, Mr. Zato. This is Dale. I can hear you.
Excellent. Thank you for joining us this morning. We're extremely delighted. Please, where are you joining from now?
Yes, I am joining from Entebbe, Uganda, just by the lake, by Lake Victoria.
Excellent. Thank you. We are extremely grateful. This is on the back of One Africa, isn't it? So thank you very much.
Yeah, without a doubt. Thank you.
Excellent.
I don't know if my video is able to show or not.
Yes, I can see your video very clearly.
Okay, thank you. Good.
Excellent. So let me just confirm that we have Stephen Amma, Head of Climate Change at Bank of Ghana. Stephen, please confirm if you can hear me.
Yes, Robert, please, I'm here. I hope you can see me.
Oh, yes, Stephen, I can see you. Excellent. Yeah. Thank you so much for joining us this morning.
Thank you.
Great. So, John Akwakuteria from KPMG Africa, Head of Sustainability. John, please confirm if you can hear me as well.
Yeah, loud and clear, Robert.
Excellent. Great. And last but not the least, we have Foster Jemfe from Ministry of Finance Sustainability. Stephen, sorry, Foster, please confirm if you can hear me.
Hello, good morning. I can hear you loud and clear.
Great, fantastic. So I'd like to say a big thank you to, first of all, our panel members who have joined us this morning in this thought leadership event. To set the context, it will be important for us to maybe just provide why we are some color around why we are doing this thought leadership event, and I will just share a few slides to set that context for this conversation. At Chartered Institute of Bankers Ghana, our mandate is to promote banking education, but also regulate the practice of the banking profession in Ghana. And we thought that it's important that we lead the pack on the conversation on things that are important. And one of them is really how do we solve the human capital needs of Africa with trusted professionals. And that means putting ethics high on the agenda of banks and bankers, and definitely putting sustainability very high on the agenda as well. So the Institute, as part of our annual Bankers Week, Bankers and Ethics Week celebrations, we've defined a theme, which is resilience in the financial system, navigating horizon risks. Resilience in the financial system, navigating horizon risks. And one of the risks that we all know is climate risk. And perhaps we should move the conversation beyond risk to opportunities as well. So that's the spirit within which we are having this conversation. Climate change, a risk or opportunity for us. And I think as bankers, we have a key role to play. This is Accra, Ghana. I think the very look of it feels very green. And that's the country we want, and that's the environment we want. But this is also Ghana. And that's the impact of drought in the northern part of our country. And that drought clearly across 6 or 8 regions is creating significant challenges from food security to the very survival. So is there a real existential threat that we face? And maybe the question is not, is there a real existential threat? is actually what do we do about it? So as banks and as organizations, it's important we do something, and doing nothing is not an option. I quote Mark Carney, the former governor of Bank of England, now deeply involved in sustainability and climate-related issues. He says that firms ignoring climate crisis will go bankrupt. Firms ignoring climate crisis will go bankrupt. And that's a quote that puts things in perspective for all of us. This is a village in the Volta region of Ghana that has been impacted by flood recently. And this is a historic site, again, in Ghana that faces climate change destruction. Well, it's not just the ones that we can't control. It's also the ones that we can control. This is a river Pra in Ghana that has been turned completely brown from the picture you see on the left, which is to the one that we are seeing as a result of illegal mining activities, popularly called galamsey here in Ghana, destroying water bodies. Perhaps riches for few people, but disaster for many and for all. There are different approaches and people involved in the fight. So the question really is, where are the opportunities and how do we move the conversation from this crisis related to climate to opportunities? And I'm showing you a slide. The Chinese, I'm told, write the word crisis with two brush strokes. Two brush strokes. One stands for danger, the other stands for opportunities. And so even in the climate risk and climate-related crisis, there must be opportunities as well. And I'm sure for those our experts on this call, the opportunity size, according to the UN, which estimates that we need about 7 trillion in terms of investment each year to achieve the Sustainable Development Goals by 2030. And from an African perspective, that means huge opportunities for us. So what can we do and what are we doing about it? At Chartered Institute of Bankers Ghana, we believe that it's important to collaborate to address the issue, to put together partnerships that can help us move forward. And I think that's goal 17, and quality education is at the heart of that. And developing trusted professionals will be very critical. And that's why we collaborated with the IFC and the EPA to develop what we call the Environmental, Social, and Governance Certification. But that's just the starting point to promote ESG best practices in the financial sector, but also give meaning and support to what the central bank is doing in terms of issuing the sustainable banking principles. So if we put that in context, in 2015, there was some discussion paper on sustainable banking principles. In 2019, Bank of Ghana actually launched the principles with support from IFC, and there has been a series of capacity building. Just yesterday, I know there were some stakeholder engagements. And most recently, and thanks to the hard work of people like Stephen, we have an exposure draft on climate-related risk or climate finance and the risk associated with that. So it's really putting this in context for all of us. And what we want to do is to get your view, experts' view, on this important topic that impacts every aspect of our lives. So I'm going to just do it this way. I'm glad that we have Ministry of Finance, we have Bank of Ghana. So that's Foster from Ministry of Finance, Stephen from Bank of Ghana, Sustainability, in fact, Climate Unit. And then we have that's John from KPMG Africa, and definitely Dio from IFC. You cover Sub-Saharan Africa, and we are extremely grateful to you. On the call, we have a number of members of the Institute, fellows of the Institute, students, and other stakeholders who have joined us this morning. So I'm going to maybe start with you, Foster, from the Ministry of Finance. If you don't mind, just your opening comments, if you can use that to explain to us what this whole climate risk that we face is, but also what's the climate adaptation? I've heard that climate mitigation financing. As a country, where are we and what are we doing about it? Maybe that should set the context for follow-up questions as well. Foster, please, if you can hear me, you have the floor.
Okay, thank you very much for the opportunity, and it's always very interesting for us to be gathered and having this discussion, which has been ongoing for decades now. And also very happy to be part of this engagement, especially with the financial institutions. And I'm happy to hear the quote that that if you don't include climate financing in your portfolio, in terms of the financial institutions, you will go bankrupt. I think it sets it all, because about 10 years ago, the financial institutions mostly were not on the table to have this discussion. So it's good we are having this discussion. I see that now the financial institutions are much interested even those on the ground. So it's good. So to respond to the question, I believe the call on climate change is, I think, is fundamental. And currently, we are not talking about climate change as different from developmental agenda. Now, climate change and developmental agenda is fused together. So that is the big interesting thing that now, and the climate change has become one of the defining issues of our time, whether we like it or not, because now the evidential issues of climate change is huge in terms of the impact of climate change on people, on the nature, and also the increasing rate of climate change and all that. So it tells you that there's nothing that you can deny. It's no longer a host, like others also say. There's the urgent need to speed up the fight on climate change, and we believe that we call on all to be part of the agenda. That is why Ghana, in its own way, has committed to the fight of climate change, ratifying the Paris Agreement and also the needed convention and all that, and also indicated that it wants to spend so much billion and to be able to fight the agenda and implement actions of climate change. So I believe in the nutshell, to say, even though Ghana's emission is very minute, less than 0.002% of the global emission of more than 60 gigatons CO2 equivalent, we still have to minimize emissions. So we have a package in our NDCs to be able to reduce emission by 64 million tons of CO2 and all that. And we have been doing a marvelous work. And I believe that that is why now Ghana is in a light line when it comes to climate change in our emission target. In terms of a very important area, that is adaptation, making sure that we become resilient towards issues of climate change. We've been doing fantastic, even though there are a lot of gaps that need to be filled. In terms of resilient infrastructure, also making sure that we secure, we ensure our food security through climate intervention, and ensuring that at least we go beyond just putting measures, just giving assurance to climate insurance. We've done all this package and all that to make sure that we are able to get there. In terms of what we have done, there are a number of things that we have done. When it comes to the totality of amount that has come in, if you take them in phases from 2015 to 2020, 2020 to 2020, till now, we've done marvelously. Before 2020, where as a country, we're not doing that bad, spending about 0.3% of our total GDP on climate change through a study that we undertook. And beyond that, after 5 years, we spent about 3% of the total envelope on as a country, not with the development partner, as a country, on climate change. And beyond that, we have done so marvelously. But if you go to the flip side, that is the external partners, the Green Climate Fund, we've been given opportunity of assessing about 870 million in various phases. About 80 million is coming directly into the country, while the remaining is through a collaboration of programs. If you also look at other interventions, such as the Global Shield, we've done marvelously over there. Having said all this, the private sector has always been the engine of growth and will continue to play a vital role, including the financial institution. That is why just last month, on the 9th of October, led by the Ministry of Finance, and all of us together, because this is not one person's work. All of us, the central bank as a regulator, the financial institutions are part, other government institutions are part. We developed the first phase of the Ghana's green financing taxonomy. That is what's going to drive the agenda of how investors should approach and also come in, how financial institutions need to target, how the beneficiary and also communities need to reposition themselves to tap into investment. There's a lot I'm told about between 3 to 5 trillion financing out there. We need to find a way of tapping into it, and that is why we've done that. Beyond that, the sustainable financing, we've developed that to make sure that at least we can drive the agenda on sustainable bonds, green bonds, and all that. So there's a lot that is being done, and we believe that we are not there yet. There are a lot of gaps that we can be able to close up, working in collaboration with all our partners, such as the financial institutions, our development partners, and most importantly, the communities and the civil society, who have been a very strong pillar in the fight on climate change in the country. So that is my initial comment. But having said that, I believe that what the financial institution, the momentum will not die off. They will enhance on the momentum for us to be able to accomplish the oral. The 1.5 degrees low carbon emission. Thank you very much.
Thank you so much, Foster. That's quite comprehensive in terms of the risk we face, but also the opportunities from a funding perspective of what Ghana is doing about it. I'll go to Stephen. Stephen, you issued a climate-related financial risk exposure draft as a central bank most recently. And I believe that you received some comment from stakeholders on that. Why don't give us an overview of that exposure draft, what is expected of financial institutions from the regulator's perspective?
Thank you very much, Robert. I hope you can hear me.
Yes, I can. We can.
Thank you very much, and good morning to colleagues, panelists. Foster, good morning. Probably let me start from where Foster ended, maybe just to add a bit to what he said in respect of the background as to why various stakeholders International standard setting bodies are all really working hard at ensuring that we address this issue of climate change. Of course, like he said earlier on, the climate-related risks have actually gained prominence and widely recognized as critical risks that have far-reaching consequences for global ecosystem and economy. And of course, it's not surprising that international standard bodies are making consensual efforts to address climate-related issues through the development of principles, standards, and what have you, to ensure that we have our hands around these particular risks. The point is this: the scientists have been able to convince us that we are reaching climate tipping points. And these tipping points are thresholds, if crossed, will trigger large-scale and self-perpetuating changes in the Earth climate system. The scientists suggest that at least 4 of these tipping points and possibly many more are likely to be exceeded if temperature continue to rise. And of course, if you look at in the ice that we have, what we call the Greenland, and of course what we call the West Antarctica, where the ice are, you normally when you fly and you go close, you realize that the ice beginning to melt, and as they melt, they increase the sea level, and that when the sea level rises, it has implication on communities living alongside the sea. What the scientists are saying is that we have less than 8 years to cut emissions by nearly half, and less than 30 years to reach net zero in order to keep global warming to within the 1.5 degrees Celsius. So what they're saying is that if we are not able to reach the net zero, which is the reaching global warming of 1.5 degrees by 2050, then we're going to see more of climate events happening, like what happened recently at Florida. We also how a whole community was wiped. And of course, even in our own jurisdiction here in Ghana, quite recently, we saw what is shown as the Mepe issue incident. We've seen the Kasua incident. We have many more incidents of flood, which is one of the climate risks drivers under physical risk, flood. And we also have issue of drought, like you show us the northern part, which is affecting agriculture and affecting production of food. When that happens, then of course it has implication on food prices, inflation in the system. So what the scientists are saying, there's some kind of back into that. It makes you see that if you are a regulator and your concern is safety and soundness within the system, of course, you have a clear mandate of price stability and financial stability, which also focuses on ensuring safety and soundness for financial institution. Then you have the objective, you have functions, and of course, then you have the powers. You need to use the powers that have been given you within the law to see how best you address the issue of climate change as part of the financial stability mandate. So this was just to add a bit of back into what Foster was saying, the need and the reason why we had as a central bank to really address the issue of climate change, because we have incidences and it does affect our mandate as a central bank. Yes, you're right. We had to come up with some policies to address the issue of climate change within the financial system, because then, like I said, it has impact on our mandates, which is the price stability and then the financial stability point of view. Now, we have issues on initially when we started the journey in 2015. The idea was the question is that how are you going to address climate change in addition to all other environmental issues? Because climate change is not the only issue we have in Ghana here. We have other environmental issues like pollution, waste management, and water scarcity, what have you, including the climate issues, which are currently also impacting us. And then we have other social issues, like gender issues, human rights issues, employee health safety issues, financial inclusion issues. So from a regulatory perspective, when decided to tackle all these issues at a go by issuing broad sustainability principles, of course, that focuses on environment, social and governance issues to address the issues all at a go. And so we came up with 7 principles for the financial institutions to really enshrine them in the operation, that while they are doing their businesses, they must take the environment into consideration, social issues into consideration, and must have a robust governance that will ensure that these risks are being addressed. So we came up with that principle. Subsequent to that, we realized that the climate also has become a big issue. And like I said, climate is one of the environmental issues, a very key environmental issue we have to also address. So we've also come up with a directive. In fact, the point is that in 2015, when we're designing our principles, the Basel, which is a standard setting body, and come up with prudential policies for jurisdictions to adopt to ensure financial stability, had not come up with anything on the climate. Thankfully, by 2022, they came up with the Basel core principles on the climate and how financial institutions and regulators should really look at it and address the issue within their specific jurisdiction. So that gave us something to work with. And then also the NGFS, which is a network for greening the financial system, focusing purely on climate, how to come up with some policies and guidance for supervisors to address the issue within their specific jurisdiction. So we've picked all these, information, and we've been able to look at what is happening in Ghana, and I've been able to design a directive that will guide the financial institutions in their management of this particular risks within their own operations. And so broadly, just to give you a broad, maybe I'm sure later on you ask me further question. We have been clear in that directive, the supervisory expectation, what we want to focus on. We have been clear on the governance side. We have been very clear how the institutions should put in place robust governance to address this issue. We have been clear on the strategy we want the institutions to be to adopt in addressing the issue. We have also been clear on risk management practices we want them to adopt. We have been clear also on the metrics and targets, the things they need to, their own target they must set, and how they should address the whole issue of the transition plan that we do expect them to have if their exposures, they are highly exposed to this fossil fuel that contributes so much to the emissions in their system, which is actually contribute to this whole lot of climate events. So we have been clear, and we have been provided a transitional arrangement in the how we're going to roll out this whole directive. I think later on, I'm sure you come back. So I'll end here that on broadly, we have been clear on areas that we want the financial institutions to put in place to address the issue of climate because of the implication it will have on the safety and the soundness on a going concern basis. Let me probably end here, and I'm sure you will definitely come up with other questions for us to do detailed discussions on that. Thank you very much.
Thank you very much, Stephen. That's quite insightful. I'll come back to you definitely on what your expectations are as a central bank in terms of how financial institutions should innovate in terms of the solutions that they must offer, how they should actually allocate capital towards that. So I'll come back to you, but that's really insightful. Thank you, Stephen, from the Bank of Ghana. Let me quickly acknowledge that this conversation we are having, which is a CIB Ghana Thought Leadership event, forms part of our annual Bankers Week celebrations under the theme, Resilience in the Financial System, Navigating Horizon Risks. And we think climate-related risk is one of those risks that we need to navigate and do so carefully. I'm glad to mention that our lead sponsors for this year's Bankers Week are GCB Bank PLC, for our financial literacy program being sponsored by GNPC. And then we have other sponsors, Fidelity Bank, First Bank Ghana, and Prudential Bank. So thank you to our sponsors for supporting this course. I'll go to, before I go to IFC, let me go to KPMG Africa. I know you've issued, John, you've issued a thought leadership, paper more recently. I'd like to know from you, and I'm sure our audience wants to hear, what are the climate, financing trends, if you like? What climate finance trends are you seeing? And what's our global response from where you sit? How is Africa doing? Are we making progress? What trends are you seeing? There are opportunities as well. It would be good to hear your thoughts. This is more from a KPMG perspective. John?
Thank you, Robert. And also thank you for the opportunity to add to the knowledge on climate financing. And I would want to start to, based on your presentation, to make it quite practicable, or put it more in simple terms, to also help our audience that we are not doing well. I'll start from that, and stemming from Ghana, given the case of the alarming issue about Galamsey, right? I'll just give a practical example. So we mentioned about ESG and also climate financing, and we need to put it into perspectives. There is a risk component, right, that talks about what are the eminent environmental issues that are pertaining to our land, our air, and also the various things around us, right? In treating that, we also forget about these environmental issues are dwell or embodied in communities, right? And human beings are the one here, and also animals. And therefore, if we do not look at that perspective and see how we treat it from a risk perspective, a risk assessment perspective, we will not be alarmed, but just say that, okay, there is a risk issue, so what are we doing about it? There is a social issue, right? And I believe in practice that there's not one categorization of an environment issue. In any environmental issue, there's a social issue. So the question is, how is the social element being critical as part of our climate issues? It has everything to do with our water bodies, the water that we drink in, which will have effects on our health due to a case in point of what you mentioned, Galamsey. We may not be able to get good cleaning water if this is not addressed. And there's a climate issue because apart from the land security that we are losing to Galamsey, we're also losing the water body issue. That's for the risk point of view. Now, moving beyond that, there is also another element of what is the impact. So the question is that how do you see the progress of this issue about Galamsey? Are we winning or we are losing? We need to have a baseline to know that, okay, well, there's a Galamsey issue. What is the banking system doing about it? The banking system could come up with an intervention to say that, hey, we are going to exclude all businesses who are into Galamsey. And there's a directive that the Bank of Ghana would explore to say that all banks who are financing illegal mining should have a placeholder on that, should have a directive against that. What does it do? Just like what Mr. Ahmad just mentioned, it's going to help the price stability and also the monetary directive therein. It's all come back to the same matter we are talking about. And this is very practicable. Number two, beyond the impact measurement, we talk about reporting. And now it's so evident that we have the IFRS 1.2, which Ghana is making a lot of strides in ensuring that they comply. And it's largely on these four pillars. And these four pillars are supposed to demonstrate a company or a bank's capacity to be able to internalize this across an organization. So it's not the reporting just to have a reporting per se, but also how are you internalizing and showing up for in terms of your strategy, in terms of your governance, in terms of your reporting and metrics, and also how are you embedding it in your risk management system. So I've mentioned three things so far: risk, impact, and also compliance. Now, the last two that I'm going to mention that talks about a matter we don't talk about, and is about the sustainable financing or the opportunities part of it. beyond the risk, beyond the reporting and impact, beyond the compliance, what are we doing? I believe we need to change the conversation around. How do we design instruments? How do we mobilize the right knowledge and data to be able to show for that? Example in point is this same Galamsey issue. We can treat it. And how do we do that? Is using the evidence of the crisis that is happening to develop a program to say that, look, we need to mobilize an X amount of money so that we empower small scale miners to be able to regularize their business and save jobs whilst improving livelihood and communities. This is the practicable solution that I'm giving you. And there's no rocket science. What I'm saying is, how do we develop an instrument or a program to say that this is the crisis that is happening. If we don't have we don't solve it within the next 5 years, you and I are not going to have clean water. We're going to import water from elsewhere. Those are what we call the opportunities that Africa needs to start thinking towards. And the last part is what I call value addition. And that's what I call the icing on the cake. After you've done all these 4 things, you build a track record which you show for it. And therefore, if you are looking for any funding partner, it's just a matter of having a conversation or showing what you've done. Now, going back to your question, how are we doing? I think we can do more. And with the works of Bank of Ghana that you've done so well to establish the Ghana Sustainable Banking Principles, which I know in Ghana they are doing so much. I know that even yesterday or a day before, there were certain trainings that they were doing. And also there are certain programs like this to create the awareness and create the knowledge so that we build on standards. So you have the IFC standards, right? These are standards that are supposed to demonstrate how do we categorize environmental and social risky projects? How do you treat them? And what are the steps that are there? IFC has sector standards. The question is, how am I supposed to learn and apply them during my investment decision or my credit decisions? Now, Foster has mentioned that there is green taxonomy that they've launched. That's a great thing, because without you not having a taxonomy, it means that you cannot identify what is the green and what is not green, unless it's based on assumptions that are not unified. So again, these are there. So these building blocks form a pathway for you to say that, okay, now it is a good start for us to say that the Ministry of Finance can now, through its policies and direction, can able to mobilize funding through various channels that they can be able to say that we want to dedicate this amount of money for renewable projects, and also with the support of banks and also savings and loans and other financing intermediaries. This can be channeled through sustainable financing or climate financing. So I think that if you ask me, there is a in-between state that we are in, that there is more to be done. And forums like this, a forum like this is very critical for us to share and also build knowledge on what do we do going forward. Thank you.
Excellent. Thank you. Thank you very much, John, for giving us a pathway and allow the risk, the impact, and the compliance side of things, but also move quickly to the opportunity side. And like I said before, every crisis actually presents opportunities as a financial sector, given our catalytic role. What instruments and what products, and how do we demonstrate the value addition that would attract the necessary funding? And that's where I pivot to Deal from IFC. You cover Sub-Saharan Africa. And this conversation must be sitting right within what you do on day-to-day basis. So Dio, if you can hear me, I'm just, the gap, in terms of financing, as the UN has indicated, it's quite huge as we speak. And as we trend towards 2030, it appears that that gap is really difficult to close. So my question to you, dear, is how do we really close and bridge that gap between the climate finance commitments, but also the actual disbursement, particularly towards developing countries in the African region? And if you use the opportunity to explain the IFC standards, that would also be very useful to our audience, because what we are here for as an institute is to bring awareness and bring knowledge and educate. And that's what we are seeking to do through this thought leadership. So, Dio, if you can hear me, you have the opportunity to speak.
Thank you very much. And appreciate very much the invitation to speak to the Chartered Institute of Bankers and all your membership, as well as to acknowledge some of the great work that is being done in Ghana with regards to climate finance. So thank you very much for this opportunity. Perhaps maybe starting by framing what the gap is, and according to the Africa Development Bank, the region loses between 5 to 15% of GDP per annum to climate change, and this is where we kind of see a lot of issues happening with various storms that are happening and destroying property, destroying infrastructure across the region, and more importantly, really putting a huge burden on the one sector that employs over 60% of our population, which is agriculture. And the challenge with agriculture for Africa is that it's 95% of our agriculture is rain-fed. So this is a real challenge for our farmers, and it's a real challenge to food security for the continent at the moment. So, the UN, Africa Development, and IFC did a study, and which came out and determined that in order to meet the national determined contributions under the Paris Agreement, Africa requires 2.8 trillion between 2020 and 2030 over that 10-year period. However, the continent's current annual climate finance flows stands at just about 30 billion per annum. As you already heard from my fellow panelist from the Ministry of Finance, Foster Gyamfi, in Ghana today, the public sector has only been able to mobilize, a certain amount of sums through the Green Climate Fund, as well as various other initiatives. But this is still very short of what is needed in order to address all the challenges that Ghana has. And what we are seeing is that gap that stands today at 30 billion is being the annual flows that the public, and primarily the public sector, is mobilizing this. It does leave an annual gap of over 250 billion annually for the whole region. And that is the gap that you're speaking about. And so the question for us is, how do we bridge this gap? There are various things that we need to consider. Firstly, that the cost of that transition to more climate resilient economies is staggering. Already, just considering that we need about nearly $300 billion a year, that's a staggering amount. And so there's a challenge as to where do we source that. But the more increasingly urgent issue is the fact that financing gap seems to continue to widen, especially when we have the impacts of climate change already destroying infrastructure, as an example, and destroying our crops and the cycles in agriculture, and which means that we have challenges with food security immediately today. So that gap is increasingly widening, and to that extent, it means that it's quite urgent that we augment the public financing that we have today with private capital. And we need to ensure that private capital is playing more on providing support for direct funding into climate finance or sustainable financing as a whole. The second thing is we also need to look at how the domestic climate finance strategies can be supported with more international finance mechanisms. And what I was really happy to hear what Stephen from the Bank of Ghana actually spoke about with regards to setting up the sustainable finance principles, as well as NGFS working together to ensure that there's a clear guide and to financial institution on some expectations that the Bank of Ghana has around risk management, around governance, around transition plans. But this is collaborative work where you see the domestic climate finance strategies are being augmented by climate finance strategies and mechanisms and best practices that are happening globally. The last element that is critical for the region is the balance between mitigation and adaptation. As we all know, our region is the lowest contributor to greenhouse gas emissions, and that continues today. But a lot of emphasis is being placed on mitigation. But our continent actually needs more of adaptation and resilience, especially when we consider that, as I mentioned, the sector within agriculture. Agriculture requires more adaptation funding, specifically to support the resilience and building resilience. For example, using agriculture technology so that our farmers will actually will have better information or guidance with regards to the changing weather patterns and how to also manage crops and ensure also the soil health so that they can really boost production. So these are some of the, just to lay the ground on where one, the gap, and then secondly, where we need to augment, which is firstly that public finance is not meeting the needs today, the 250 billion gap. We see private sector as being a key catalyst to meeting that gap. Secondly, supporting domestic climate finance strategies with best practices from globally, and for the continent, really having a lot more focus beyond just mitigation, but more on the adaptation strategy. So I think that's the first thing that I would like to lay out. And in order to do this, I think that I would like to go back to what my co-panelist from the Bank of Ghana, Stephen Armour, spoke about with regards to setting standards, and to your question around the importance of standards. And as you know, IFC, being one of the earliest issuers of green bonds, has been driving innovation in the market by setting standards, deploying new financial products, scaling up existing ones. What these standards actually do is they provide the standards provide a basis for us to have common principles that we follow. They also allow the transfer of best practices across different jurisdictions, and also being able to share skills and also build capacity in each one of the regions. So IFC has been at the forefront of setting the standards globally and sharing this, and through that we do see, in fact, the Bank of Ghana is part of the Sustainable Banking and Finance Network, which is a network that IFC set for regulators to engage globally, to share the experiences in providing guidance to the financial institutions within the country. And Ghana has been a very active participant in that network, which also has led to the benefit of Ghana to actually set up the standards, be part of the NGFS, as well as to put in all of the different structures that today the financial institutions and the guidance that the financial institutions have in the country. With regard, and further to your question, with regards to how we would be able to, what would we be able to put in place in order to, meet this gap? The first and most important thing for private sector to participate, a key focus is in overcoming investment barriers, and we have to think as DFIs, one of our critical areas of engagement is how to support the public sector on creating an enabling environment and establishing public policies that encourage the implementation of various environmental and mitigation and adaptation policies on one side, but also reference projects that actually are able to then showcase the possibility of being able to address the issues. So that is the first thing. I think the second one is I would echo what my colleague from KPMG also mentioned, is how do we build confidence by reducing risk? The private sector, one of the key issues for the private sector to participate is the issue of risk to be able to address issues in a country like Ghana. The private sector will participate to the extent that they feel that there are some risk mitigants for the exposures that they're going to take. And this means that they have to be targeted interventions that are aimed at reducing or reassigning or reapportioning different investment risk. And this would then increase the attractiveness and the acceptability of some of the investments in climate by providing coverage for private sector and for the exposure that they have. Some of those could be either having guarantees, as an example. As DFIs, one of the key risk mitigants that we have is looking for blended concessional financing that reduces the cost of transactions, the cost of financing, and therefore ensures that the private sector still is able to address social need, address growth of green portfolio, but at the same time also have a good return for the cost of money. Insurance and putting together the right type of insurance. One of the areas that IFC is working on, especially towards adaptation, is looking at agriculture insurance products and how we can be able to support that, as well as looking at ag-tech investment that would be able to help our farmers. Debt subordination, is also another way of ensuring that the cash flows are actually have a proper repayment priority to certain holders of debt, and that way can make it a more attractive for financing for various project opportunities. Another way of enabling financing to flow is also by employing transaction enablers. And what you'll see is a lot of clubbing deals where you have financial institutions coming together, warehousing as an aggregation of in order to reduce the transaction costs of a deal and facilitate therefore investment. Securitization, which is a clear technique that enables cash flows. And if you think about securitization, particularly for investment in climate projects like solar leasing or power purchase agreements, this really can transform and create standardized ways for ensuring circularity of financing and attractiveness of investment for climate finance as well. We do a lot of co-investing as well, and also we do encourage quite a number of transaction enablers like leasing as well, which enables customers to use certain to be able to access certain assets such as rooftop solar and reduce the barrier to actually accessing that. A last thing that IFC, two other things that IFC really does, and in order to kind of bring private sector into where this financing is needed, is building capacity through our advisory team. And what IFC will encourage to build local expertise, national expertise in low carbon technologies and projects, create the understanding of the risk return appetite, ensure that the standards that are required that would make it palatable for international investors to participate are applied in structuring of investments. And in this way, really kind of develop that expertise to then address local situations and local issues, right? As my colleague from KPMG mentioned, there's risk is one, but there's an impact. There's always a social issue in all of these investments, particularly for Africa. And when you build that expertise and to be able to use this international best practice mechanisms and understand how to balance the risk reward quotient, you're able to then really originate opportunities that are critical for Ghana. And through that, being also to take beyond just originating it, is also consider what is the value addition that Ghana has for its own locality and for the rest of the world. At the end of the day, the environment is for all of us at the end of the day. And then the last most critical things is also putting together tools, mechanisms that would support the transition effort. So a good tool that IFC has put together, which would be a great example, is in real estate investment. IFC has developed a certification tool for green building. This is a certification tool that is being extensively used right now in Ghana. It's called EDGE, the Excellence in Design for Greater Efficiencies. It helps to certify that a new construction or even one that has been renovated, so long as it meets 20% reduction in the energy by putting solar panels as an example, putting water management systems, as well as the embedded material that is used, for example, recycled steel or the cement that was made with kind of low carbon and various recycled materials. In that way, through the certification of this green building and EDGE, IFC is able to support green building and the construction sector to understand that actually the cost of building a green resilient building is not as expensive as most people would expect. And when we speak to developers and with financial institutions who finance them, on average, developers shy away from building green and putting all of these elements because in their perspective, it eats into their margin because it's over 10%, 15, 20%. We've had a lot of developers tell us it costs 20% and I will never get it back when I'm selling my developments. Actually, the converse is true. What we've seen is the cost of that additional greening effort based on the design of the house. And it's actually the design of the house is more important. Is it sun facing? Do you build thicker walls on the side that is more sun facing? How do you put the shading? How do you manage the windows? How do you manage the airflow? What we have actually proven is that the cost of additional greening in a place like Ghana is no more than 4% of the cost of construction. And so developers now with this program that we have, one is the certification tool that we've put in, but also putting in concessional financing mechanism together with the UK government, which encourages developers to build green. We've actually been able to prove to developers that it's actually an imperative and it makes business sense to build green because once the units are built, they actually sell themselves as the uptake is quite fast as people realize that they will be buying a unit, whether it's a flat or a standalone house that has energy security, that has water security, as well as being built with good materials that would strengthen the livelihood of the family. And this is a clear demonstration of the profitability of low carbon investments, which is quite important because that's where, to the point that was made, we are then able to tap into the opportunities, understand the value addition, and actually then make it business sense for the private sector. And then this kind of enables the mobilization of capital that helps to bridge the gap between what the public sector is able to provide and the 250 billion, which we really feel that the private sector can provide.
Great, Theo. That's really educative and insightful from the gap that exists to the widening gap and the urgency of that, and even more importantly, the need for private capital and some of the things that you, from IFC perspective, are doing to facilitate that transition. Thank you. From tools to actual funding. I'll come back to you later in this conversation, but that's really useful. For the purposes of what we are trying to achieve for us is, from the Institute's perspective, is bringing awareness and educating. And if we do understand this more, then certainly as an industry, we can develop the solutions that will solve the practical problems that we face as a country and certainly as Africa. So thank you for that. I would come back to maybe Stephen. I did mention earlier on that we want to hear your expectations from a central bank's perspective in terms of what banks should do and how we should innovate in terms of design of instruments or solutions or financial products, and how capital should be allocated. And if you take the opportunity to just explain the exposure draft a bit more, what you have issued and what you expect banks to do. That would be very, very educative. Let me just quickly mention that one of our sponsors, in fact, two Kasapreku and the Kumawu Rural Banks are all supporting this event, which is our annual Bankers Week celebration. I need to acknowledge them as well. So thank you. And we have close to 300 people on the call at this moment, and we believe that the message is getting through in terms of the education, which is our mandate, really. So, Stephen, over to you in terms of your expectations, how we innovate around this, how we allocate capital, your exposure draft. What's your expectation?
Okay, Robert, thanks so much. And thank you, Du, for that submission. I think was very, very insightful. Just for purposes of the records, even yesterday, we had to collaborate with the IFC to provide training for some of our financial institutions, broadly on the Ghana Sustainable Banking Principles, one of the sectors being agriculture, because we think that agriculture, if you look at it in this country, has not been receiving, enough funding, but it's also as a result of the risks and how the financial institutions see that there's a lot of risks. But the question then comes as to how do you then now do business in a more robust risk management practices so that you don't get your hands burned as a financial institution and still get the loans paid and you continue to do business. So we collaborated with IFC on that and EPA and provided that training. And I want to say, probably let me still use this medium to just thank IFC because it's an existing MOU that, of course, pushes the agenda to ensure that we build a capacity of our financial institutions. And that, I think, is very key to put on the records. Now, let me come back to the more substantive question that you asked on the issue of expectation from the regulators' point of view, from our side here, the expectation. I think in my earlier submission, I made it clear how we do see the implication of the climate. And of course, these discussions, I'm focusing purely on the climate. I would try not to bring in the other sustainability issues in there. I'll focus purely on the climate. Although climate is an environmental issue, I will try not to bring in other environmental issues like the pollution, these galamsey issues that we have in here. But to focus on the climate, and just for the purposes of education of our audience, the climate change, there are two key drivers of climate change. We call one physical risk, and the other is the transition risk. When we talk of physical risk, we are looking at the example, we have the things like flood. And of course, even under physical risk, we have two key categories. We call one acute physical risk and the other one being the chronic physical risk. When we say acute physical risk, we are looking at the where you have flood, you have drought, you have the hurricanes affecting countries, affecting economies, impacting a lot of organization because of flood or because of, say, drought. Some companies may be depending on certain products, but if there's drought and you're unable to produce them, they get affected. You have issue of flood. If you pick what happened in, say, Kasua or in Mepe, if financial institutions have exposed themselves to that sector, you realize that the ability of the customers to pay the loan had already been impaired. And so that is what we call the physical risk. And then we have what we call the transition risk. The transition risk is looking at a sea level rise, and which, of course, I touch on that if the sea level rises as a result of climate change, because the Antarctica or the icebergs are melting or the temperature is increasing, therefore is making the sea level rise, communities living alongside the sea or the ocean will be affected. If banks have exposed themselves or we have companies that have open branches there, they will all get affected. And if they have taken loans to do businesses, definitely the loans will not be paid back. And if even they haven't taken loans and people living alongside the communities getting affected or impacted by the sea level rise, then that is going to affect the economy. And if the economy is affected, financial institutions are all exposed to the economy, and therefore they will get the enhancement. You will see that their bottom lines will not do well. When they are also not doing well, they can support the economy going forward, and they can also provide employment. So a whole lot of linkages in here. So as supervisors, like I said earlier on, there's a need for us to then come up with some guidance for the financial institutions that even though they continue to do business and finance activities, there are some of the activities that they finance, they do impact the climate, all right? They affect the climate. And so they must do things in a more robust way, in a more better way, managing the risk. And of course, even though when the climate is affected, the climate also does impact the financial institutions themselves. So we call something double materiality. Now, we had to come up with a policy or a directive to really help them to manage this whole risks that currently the climate poses. So what we've done is that in the earlier submission which I made, we have designed this directive based on what the standard setting bodies have given out in the management of this climate-related financial risk. And that we've picked the Basel document, the NGFS, and quite a number of documents in the system. And we have looked at, contextualize it to see which of the elements will fit and help us to address the risks as financial regulator, or let's say as a regulator overseeing to ensure that our institutions are safe and sound. Now, just to give you a broad bit of what is in the directive, we have been clear on the governance. We are saying that the climate do present a risk to the financial institutions, and financial institutions are in the business of managing risk. So what we are saying is that at the governance level, at the board level, the board is the main body that is responsible for everything that goes on in the financial institution. There should be strong governance at the top to oversee these risks. We want the governance to, the board should set up structures within the financial institution, look at how to manage this whole risk. The board must give serious consideration or must recognize the climate as a key risk, which then affect all other risks that they are already managing, like the credit risks, market risk, operational risks. So there's a need to have a strong governance at the top. We have been clear as to the expectation of the supervisor in respect of the governance we do expect on this particular risk. We have also been clear on the internal control framework. So for instance, if you go to a particular institution, the 3 lines of defense, what we call the risk management, or let me say the first line of defense being the business people, those who bring in the business. And then the second line of defense being risk management and compliance, and the third lines of defense being the internal audit. We want them to also integrate the issue of the management of the climate within all their processes, procedures, and what have you. We want them to take into consideration the climate in all their work. That is key. We have also been clear on the internal capital and liquidity adequacy. What we are saying is that now the climate has already emerged. We have seen, while our work with key stakeholders, we have seen that the financial institutions are already exposed. Our work with the Ghana Meteorological Department or agency has shown that clearly our institutions have exposed, looking at the portfolio levels and the hotspots in Ghana when it rains, where it gets flooded, and the exposures of these financial institutions, they are already exposed. Therefore, there is a need for them to do the assessment. If you look at the capital, which you just touched on, whatever business a financial institution is doing, they must have capital to support, because at the end of the day, it is a risk you are taking on board on the balance sheet. You must have capital that will absorb the risk on an ongoing concern basis if you get affected. So in the assessment of the internal capital adequacy process of the institution under the Pillar 2 of the Basel framework, we want them to begin to look at the climate and the impact on the capital. And if they need and they have to really bring additional capital, they have to do that. We have been clear also in the directive on the risk management process we want to see in the financial institutions addressing the issue of the climate. We have been clear, and we've provided the supervisor, expectation in there for them to look at it. We have also been clear on the management and monitoring of this particular risk and the reporting. We want systems to be within the financial institutions where issues on climate will be reported to the board for discussions and for redress. We want the reporting lines to be very, very, very clear. Clear reports must be submitted to board on very short intervals for discussion. We want the financial institutions to look at that, and then comprehensive management and climate-related financial risks itself. We have been clear on that. Then we want the financial institutions also to do a lot of scenario analysis. So, for instance, scenario analysis is that currently we are saying global warming is around, let's say, 1.1, 1.2. With the global warming being 1.1, 1.2, look at the number of climate events we are experiencing. We are experiencing flood, we are experiencing hurricane Sydney, whatever names that you can give, red tide, and all those things. We are experiencing them, and they're affecting economies across the globe. So the question is that if you are a financial institution and clearly you are exposed to all these countries or to certain sectors, and global warming is 1.2 and you are having this event, then the question is that if global warming is 1.5, what will happen to your portfolios? If global warming is 2 degrees Celsius, what will happen to portfolios? If global warming is 3 degrees Celsius, what will happen? So you must take the scenarios and build them into your stress testing to see the impact that could hit your balance sheet and, of course, in the implication on your capital, and make provisions for that. That is clear assignment. We have been clear in there. Thankfully, we're working with the NGFS. So we are saying that for a start, they can use the NGFS scenarios, which is the orderly, disorderly, hot house world, and too little, too late. And each of them, the various scenarios that they have proposed. Of course, because we work with them, some of the assumptions fit us. But you pick these scenarios and build them into your stress testing and see the implication it could have in your capital and, of course, all other things for your balance sheet, and then make the necessary capital adjustment for all these things. We have been clear. We have also been clear on the disclosures. I believe you are aware that now there's what we call the S1 and S2. S1 focuses on sustainability, S2 focuses on climate. On the climate part being S2, we want financial institutions to disclose in line with what the IFRS and in collaboration with the ISSB have issued. But we are working with the Institute of Chartered Accountants, that's the CIB Ghana, to come up with a clear roadmap for implementation or for adoption of the disclosure requirements which has been given by the IFRS. So the directive has been very clear, and then the roadmap, the implementation of roadmap. Finally, probably let me touch on one key thing also in the directive, which is the transition plans. We want financial institutions to come up with a credible transition plans towards the net zero. When we say net zero, we are looking at a global warming of 1.5 degrees Celsius by 2050. So we want financial institutions to come up with a plan, a very credible plan. That just means that they understand the transition plans of their own counterparties, that's the customers, in order to have a credible transition plan for our study and for monitoring. That we have also been very clear in the directive. I think in all these things, what we're doing is that we are trying to have a very robust regulatory environment that will attract funding into the country. In fact, yesterday in our discussions, for instance, at the La Beach, in collaboration with IFC, the issue of the GCF came up, where we know in Ghana here, EcoBank has been able to attract, in fact, it has up to 250 million to be able to really, raise that to that 250 million. But if I try some 25 million, from the GCF, which they at a very concessional rate, which they are using it to do business. The point is this: when you have that robust regulatory environment, it attracts the funds. Investors always want their funds to go to where there is robust regulations, regulatory environment, because at the end of the day, they want, if they bring their funds here, the funds at the end of the day should be able to return. They must get their returns, and the funds, the capital itself must also return. And as regulators, that of course we do contribute to ensure that we have that enabling environment, the financial stability, there's financial stability to attract funds and to support the economy. The need to roll out these regulations are very key, and to ensure that there's that soundness in the system, there's that robustness in the system to attract the funds into our economy. The GCF, if you look at the requirement of the GCF, look, I'm telling you, just to use our local, it's not for jokers. It's not a joke. It's a high requirement that requires that you meet all these requirements to be able to attract that funds. But I think in all what we're doing, we're creating that enabling environment. We want financial institutions to thrive. We want them to be able to be stable, safe, and sound, attract global funds into the system to build that resilience that we are looking at cost, both adaptation and mitigation measures being also handled by all other key stakeholders. We think that together we should be able to address the issue. Cost in addressing climate change, we believe that it's not only the government, but all key stakeholders should be able to contribute, especially key stakeholders to the financial sector, like Bank of Ghana, the NIC, the SEC, and what have you, should all contribute in addressing climate change. I may want to end probably, I'm sure you may come again for, if there's any clarification, we'll provide that to you. Thank you so much, Robert.
Thank you, Stephen. So thank you. It appears to me your submission fits quite nicely into the theme for this Bankers Week, which is resilience in the financial system. You know, how we navigate the horizon risk. But what you are saying is also, how do we build that resilience and ensure that banks have the appropriate mechanism, whether it's the scenario planning or at the governance level or capital allocation, there is some resilience in the operations of banks. Thank you for that. What I didn't hear more about is the innovative solutions, the financial institutions, but I think that will be very much left to the strategies of banks. That's
yes.
Certainly not what the regulator bother about. Yes.
Yeah, Robert, you're right. For the innovation side, if you pick the sustainable banking principle 6, for instance, which focuses on the efficiency. Of course, give the financial institution the opportunity to be innovative and come up with certain products which customers could buy into. For instance, you can have a product that focuses on customers being able to purchase things like solar. All right, if you look at Ghana, we have a lot of sun. Do you have a product that really is at a low rate that customers can buy into it and be able to purchase solar? Okay. In fact, yesterday, for instance, Andrana gave a touch on the opportunities, a lot of opportunities in the space, which financial institutions can actually take advantage of. But the key thing is that it's up to the financial institution to look at it and design the products, okay, and then sell it out to the customers, you know, and that is how we're looking at it. But in the designing of this innovation, all must be done within an appropriate regulatory environment. That is where we are coming from here. Thank you.
Sure. No, thank you. I think that's quite clear in terms of what the expectation of the central bank is and what banks must do to ensure that resilience. So let me pivot to Foster, Ministry of Finance. It's quite clear in the submission of deal earlier that private capital is required, right? And if we have to mobilize private capital, and I know bankers, we are very good at managing risk, and that's important to us also because the central bank expects us to do so. So we're not going to allocate capital if we don't understand the risk or if there is no incentive so to do. So more from policy perspective, from Ministry of Finance, what policy options really will incentivize financial institutions to scale up climate finance and given specifically the mitigation and adaptation projects, some of which have been mentioned. Are there policy options that we should expect from Ministry of Finance to incentivize banks and other financial institutions to really allocate capital, given the risks that the central bank also expects them to manage?
Yeah, thank you very much. I believe it's in order. And since government is leading the charts, there's no way we can get this done if there are no incentives for people to come on board. So first, the first thing I would want to say is that we're going to look at policy coherence and also integration. In so doing, we're going to make sure that the government policies are well aligned, related climate issues. And also for based on what we have also agreed and signed on as a country. So that is the first thing. The second thing is that as we look at policy, we'll have to look at the issues of the tax regime. We need to make sure that the tax regime is reviewed to reflect the current trend and also the demands of from partners, especially the financial institutions. So we need to look at these things vis-a-vis on what we want to get things done. And having done that, I believe we'll be able to attract more, because often than not, we always argue that we losing out on if we review our tax regime and all that, we're going to lose out. But there is much gain within the green space. There's always a set-off, and there's always opportunities that exist for us to gain from it in terms of establishment of manufacturing, in terms of the green activities that exist. The other thing is also how we can work together to make sure that there's a market access for a product that's the financial institutions want to offer into the system. And already government has been working with some financial institutions on different fronts. So by so doing, we need to make sure that we create the enabling environment and also provide the needed incentive to the risks, the sector, because as has been mentioned and all that, the sector, there are a lot of issues that exist, but to be able to make it attractive, there's a need to the risks and also bring in the needed incentive. And there are a number of projects government has, green line products that government has in collaboration with development partners brought to the financial institution. These are the kind of enabling environment and incentives that can help us to be able to move forward. The other thing is to, apart from government working with the financial institution, is to bring all financial private sector on board. So as part of the PPP arrangement that we have at the Ministry of Finance, we're going to intensify it and enhance on the green component so that at least the financial institutions can work together with government more effectively, and also to be able to bring coherence in terms of how we want to get things done. Having said all these things, if you lack capacity, you can never be able to achieve. So I'm happy the central bank is leading the charge to, and as part of also the celebration, there's some kind of engagement, and especially with what is happening today at the webinar and other engagement, is good. It's going to intensify the awareness and all that. But we need to build capacity so that we are abreast with. We need to build capacity so that we are on top of. We need to build capacity so that the skills that is required for the current and the future will be there to be able to get things done. Because we've had a series of engagement and also trying to develop things within the space, but we lack the needed skills and experience to be able to accomplish that. Most of the time, we have to rely on foreign consultants and all that. So I think these are some of the things. Lastly, I think we talked very much about the issues, strategies, and all that. I think we need to find a way of making financing to flow at will. That is a fundamental issue when it comes to the financial institutions. And to do that, we need to explore all avenues in collaboration with the central bank and other partners to make sure that we can have the needed financing, so that at least it makes this sector very much incentivized and also very attractive for players to strive in. So these are basically what I want to say. Thank you.
Thank you very much, Foster. That's really useful in terms of the need for policy coherence, but also the tax regime and market access, and how we can de-risk some of the projects and to get banks to participate. But most importantly, building the capacity, and that's where Chartered Institute of Bankers Ghana comes in, which is why we are bringing the awareness and leading this top leadership and pulling the key stakeholders together to ensure that we have an understanding, and then we can practice and allocate capital. So thank you, Foster. So what we've done so far is really get a sense of the current state when it comes to climate-related risk, the regulations, the gap that exists, the policy options. And then, of course, other products, what are the innovations that can help us address some of the challenges. Maybe the last segment is really taking a look into the future, and I'll get some closing comments from you. So before I go to IFC, let me go to KPMG. John, I know you did some thought leadership recently, and by the way, we've shared that. Thank you, John, for sharing this with us. We've put that in the chat box, so those who want to read the KPMG thought leadership paper on the sustainable finance and the opportunities can take a look at that. But John, listening to the conversations and listening to the gap, and I know you like to put things from a practical perspective. What are your predictions for the future in terms of climate financing, particularly as we, approach the timelines we've given ourselves, and given the gap and how that gap is widening? What's your view of the future? Whether it's from the gap perspective in terms of financing, but also the capacity that we need to build. But what's KPMG's view of the future that you see in this regard, climate change, climate finance, and related conversations?
Thank you, Robert. I would start from, look, I'll be very transparent with you. I think I've had an opportunity to see the 9 yards. Maybe I said being a regulator, but I think I've worked in a bank, helped establish ESG systems in a bank, done that for a development bank, done that for other lower tier financial institutions. I continue to do that work. And I see that in my TL, I highlight about 5 areas that we need to move to create, innovate, and also leverage. And now I'm going to share 5 areas. So capital is important, but I think that beyond capital, I think there are things that we are not really touching on. One of the things is what we are doing today, knowledge sharing. And it's true, there are limited, I won't say there's no capacity, but there's limited capacity that needs improvement. Mr. Amman mentioned capacity yesterday. They had a training. It's a process of building the capacity and also getting local capacity to be able to respond to the gap, right? Now, the first point is knowledge, and I think that we need to have a more deliberate attention to build capacity within the financial institutions, not just financial, within insurance, but all the financial sectors as well as businesses, because it's not just about identifying a risk, it's about treating it and also monitoring and also controlling it to be able to respond to our climate issues and also social issues. So knowledge is key, and there are technical assistance programs that are going on, which I believe from other development partners that I think that we should get our hands in, so that whilst we are building the knowledge, we are also gaining understanding how to manage those exposures. Number 2 is about data.
Yeah.
Data is everything. I mean, next to money and knowledge. Data is key. I think you're wondering what has data got to do with here? Now, data to know even the number of people who understand this field or who understand or within the financial ecosystem, what level of needs of capacity do they need? That's data that needs to be done to know that, okay, there's a directive by Bank of Ghana. How many of the bankers understand what is the directive? And using that data to be able to provide a responsive signal by providing tuning programs on that. This is key because data helps to make decisions. So if we don't have a standardization or we don't have structured data to be able to say that, oh, we need to build capacity of ESK, number of people within the financial sector to be able to improve the current state, I think then we are not really knowing what we are doing or how we are tracking improvements. Data also, it means how do you measure reduction in greenhouse gases? And also how are we being resilient to the effects of climate change? All these things are things that we need to know that data becomes important. So the question is, what does financial institution do? Financial institutions should find or should be able to create a data to be able to manage climate scenarios within their analysis to see that within this, let's say agriculture, like the way um, Mr. Amma mentioned, what are in an agric sector, what are the exposures? What will be the effect of the situation of an agriculture, let's say customer in the flooded area? What's going to be the effect? It's going to mean that there's going to be the yields may be destroyed due to floods and all those things, and you need to be able to identify those ones so that you can able to treat those risk exposures. That's data for you. I think also beyond the three things I've mentioned, there is something called credit guarantees. That is another form of, let's say, investment instrument where we believe that credit guarantees is the way forward, whereby credit guarantees are applied to certain businesses, or banks tap into credit guarantees, where businesses that would need extra to cover their first loss be able to use that to be able to manage these climate exposures. So guarantees are now, and I know that within the World Bank, they have several instruments like this that really help financial institutions as well as businesses in this route. And the last one that I will talk about is technology. How are we leveraging technology to be able to track these things? Technology to be able to know that. And when I say technology, I don't mean beyond having a built environment. How do you find innovative ways to manage and reduce, for instance, resource efficiency? How do we manage that? How do we convert from using fossil fuel powered technology to cleaner energy? That's a way of also reducing the effect of climate change. These are instruments that are there that's supposed to be localized so that we can be able to manage those exposures. So please, there's a lot of opportunities there. There is untapped ones that are there. There's also the last one I will add to the capital part is the upcoming of private players getting interested in public funds, which we call blended financing. How do you marry public funds with private capital? And that's where we see the introduction of various instruments such as development banks and also funding opportunities where we use the private capital from banks to augment public funds to be able to um, invest in areas that ordinarily would not really go there. I think that I believe that there has to be an increment of more development finance institutions so that you can be able to deploy more of these vehicles in Ghana. It doesn't hurt to have another development bank coming up. It doesn't hurt because the more of these ones coming up, the more of we having access to capital, we having access to credit guarantees, we having access to data, we having more training programs happening. We also having more of these capital deployed to various businesses, green businesses that are currently underserved because of high interest rates, and also the capacity of banks and the knowledge needs to be improved for them to get ready for. So these are the few areas that I believe that banks need to create new instruments like what Mr. Amma mentioned and move. Yes, they already have, I believe banks have the robust systems, right? They should start exploring and moving into under the right framework guided by Bank of Ghana to move into how do you develop green products. And developing green products is not in isolation of setting up an ESG system or an environmental and social management system. They work hand in hand. So you need to, and if if you just check a, if you just develop a policy for the sake of Bank of Ghana says do that, I believe that you are not helping your financial institution. And also, you need to have a dedicated team as financial institution. A dedicated team. I see a lot of financial institution having at least one person managing a whole environmental and social management. And I'm asking that does the person have time to manage or to screen against all these exposures? So it's a miracle, honestly. And I think that banks need to move beyond that and dedicate resource. And these resources should not be lower level people. You need to recruit senior people who understand this. And I also give the opportunity. I was given the opportunity way back about how many years? About 10 years ago in one of the leading financial institutions to help set it up, Fidelity Bank. And I quite see that, I look back and I see that they've been able to evolve that function to become one of the leading financial institution with the incredible system. So I think that there has to be commitment. And just like Mr. Mas mentioned, the tone should always sound from the top, and you need to invest. Just like you're investing in having an operational risk department, just like you're investing into a credit management team, you need to invest in this so that you can able to rake the opportunities. And I'll pause here. Thank you.
Great. So thank you very much. Do I see a hand up? I was John, also trying to gauge whether you think we can close the gap and how we do that before the deadlines. And but I'll come back to you maybe in terms of your closing comments. Let me quickly go to IFC. Dio, and before I do, let me mention that we'll use the last maybe 10 minutes or so to just get some comments. And so those who want to ask questions or provide further perspective can do so. But Dio, I think it's clear that we have opportunities. It's clear that there are funding opportunities available, or if you think about it, there's opportunity in this space. So if I have, and I know a number of bankers on the call, what are those funding sources if you just itemize them? And I know maybe IFC is in that pot. But also, what are the barriers to accessing those funds? And therefore, if I'm working from this call, what is 1, 2, 3 things that I must do to play in this space and play well and take advantage of the opportunities? Dio, if you don't mind sharing some thoughts. And I know where John, landed. It's important in terms of tone at the top. But I think from the institute's perspective, the tone at the top is important. The mood in the middle is important, and I believe the bars at the base, and that's why we've put this program together. But we also have an ESG certification program, which is currently ongoing for different segments of people working in financial services. But over to you, Dio, in terms of funding and assessing same.
So if I understand, the question is around the funding sources for climate finance?
Correct. And then also barriers. But if I have to walk out of this meeting to do ABC, what would those be?
Okay, so I think the primary funding sources, the financial institutions really need to kind of create and look at climate finance and addressing issues of climate as a business imperative on one side, but to Akua Tawia's points earlier on, to look at it as opportunities. So the funding sources today are, there's a lot of commitments that have been made from the global north to look at the global south and be able to support in meeting some of these gaps that we've talked about. However, I think the critical element to really be able to access that funding is the frameworks that ensure that the use of those funds and the use of those proceeds will actually meet the greater impact that it is intended for. And so beyond just talking about the funding sources, I think the critical thing is how do we lay the ground that ensures integrity towards the use of the proceeds and towards the task at hand and the commitments that we're making that we want to achieve. So, for example, Ghana has submitted its national determined contributions, and the framework and enabling environment that actually ensures that there's a very robust process to addressing and meeting and those national determined contributions is what is going to create the pathway for the funding, as it provides confidence in what those funds will be used for. And to this extent, having the adoption of key standards, principles, or frameworks are critical to ensure that this happens. As Foster mentioned earlier on, Ghana has adopted a green finance taxonomy that classifies for all investors, the different categories of investment in green assets. What are the targets that are being met? How do you ensure that it is the impact is actually quantifiable and achievable? That framework is critical to show, and the implementation of it and the guidelines that shows clear implementation and robust sort of review and continued expansion and improvement of that taxonomy is quite critical to be able to channel funds into Ghana and to be able to address the national determined contribution. So I think the beyond just the sources of the funds, and I think even in the local scene, it's not always just about funds coming from outside the country. In order for financial institutions within Ghana to then be able to address issues such as the issue that we were addressing around illegal mining, as an example, is to the extent that there is a robust framework that actually is able to ensure that no funds or availability of funds that supports illegal mining is stopped. There's a robust process of prosecution for any illegal mining, and then the security of that, it will enable financial institutions to then operate and say what is a better way to engage, and how do we then retain the water resources for the country, and which we may challenge, for example, as we've seen, sort of cocoa production, right, and support that. So I think the main thing that I'm getting to is, yes, having sources of funds is great, and outlining them or listing them is great, but the funds will not be deployed without a framework and a robust framework that shows that there's integrity in the deployment of these funds and reporting back. And you will see that IFC, as a co-chair of the International Capital Markets Associations, one of the key things we've done in that is if you're issuing a thematic bond or loan, whether it's a green bond, sustainability bond, sustainable linked instrument, one of the key things is having the very clear, robust process of putting together a framework which is third-party verified of the uses and of the proceeds, as well as the management and governance structure within that financial institution or within that issuer, and the reporting structure that ensures that beyond just a pure return for financing, you're also truly achieving the impact that you set out to achieve with those funds. And if that cycle is shown that you're able to deliver on it, for sure, more funds will come. And I think what you're doing in being able to boost knowledge of ESG, as an example, boost knowledge around the process of issuance and how to kind of set up a framework for issuance of these thematic instruments, that in itself will actually create a clear channel and integrity within the market. I would actually say that if we were thinking of current trends of green financing or climate financing, sustainable finance, one of the other things that we are seeing is, of course, beyond just a pure green bond or sustainable bond, we're at the funding pool is expanding to actually look at what are the core benefits of climate, what is sustainability across the environment, and also starting to think about that it's not purely just mitigation, as I said also before, adaptation. It's also looking at other areas that are critical in our environment. So Ghana has a huge coastline, so there's a blue economy. So how do you then target the full economy that is there, the biodiversity of various areas? As I think the illegal mining actually, one of the key damaging impacts of illegal mining is actually destroying the biodiversity, destroying the water table as well, and that then destroys quite a number of things that completely degrades the environment where this illegal mining is happening. So looking at starting to invest in targeted areas where we are considering nature as the core central sort of investment target, as well as the core benefits that come with it, the social impact that it will have in that locality. If the water table goes down, of course, in that area, agriculture will be impacted, but also the communities there will be impacted, and they will not be able to get safe water for drinking, as my colleague Akoko did mention before. So we've got the investment today is expanding. The area of sustainable financing is expanding in where it's targeting. It's getting a bit more specific with regards to the impact that it wants, that it's aiming for. However, any investor who is going to put in funding, the key element that they will be looking for, how robust is the process of an integrity of that particular investment. So I think that's probably one of the most critical things. Now, what do we do then, therefore, in order to address some of these issues? As IFC, this is why we insist when IFC is investing, is working together with an issuer, working together with a financial institution to put together a robust framework for any issuance that they would have. IFC, to the extent that we go through the process of putting together a robust issuance framework, whether it's a green bond or a sustainability bond with you, that then we actually have some donor funds as well that then helps us to fund a third party, a second party opinion or a verifier who will then review the structure that financial institution has put together as an issuance framework. And that structure incorporates a number of things. It's obviously the target on the use of proceeds, so defining the classification of the use of proceeds. It's the management and a governance and management framework for all of the funds. So ensuring, as again my colleague from KPMG mentioned, it's not just an individual that is kind of providing oversight, but it's a team, and also frontline staff within the bank are trained to be able to originate and to manage the engagement with clients and on lending of the funds, to ensure that there's a clear sort of management and robust management process, as well as the treasury function understanding, the risk function in the institution, understanding what it means for the bank, and then putting together a proper reporting framework that actually tracks, a proper tracking and reporting framework that tracks the funds, and to the extent that institutions that IFC has invested in and issued across the region. So IFC over the last 3 years has invested in quite a lot of green issuances, whether it has been in Nigeria or in South Africa, in Kenya, in Egypt, Morocco, across the continent. This is the principle of participating and putting this framework, putting in that structure, has always enabled IFC to then be an anchor investor in most of these issuances that supports domestic investment in climate finance. When IFC supports the process, becomes an anchor, one of the things that you will see, it crowds in a lot of investors because they are looking to IFC that there was an integrity that was maintained in the process of structuring this funding. And so we've seen it as a very clear responsibility for us of ourselves, which is one, to support the process of educating and putting together the right framework. But secondly, it's also a function of us also crowding in investors, both international and domestic, towards investing in climate investment and investing in these structures, and supporting the process of reporting. And once we do this, and it becomes a normal process of how you aggregate funding, and it becomes, from one institution to two institutions, three institutions. A good example is Tanzania, where we started off with one bank, CRDB, about a year and a bit ago, and now we're with the third bank also issuing green instruments. So it's becoming something that the market is seeing more green issuances, more sustainability-linked loans as well, both targeting green assets, but also really targeting the social aspect, as well as carve out for gender and financial inclusion. Very, very important. And this kind of enables financial flows to start tackling the issues at hand in the locality, and more specifically the areas that are most vulnerable in our communities as well. I would say a couple of other things to really care for. And by the way, with regards to the frameworks, I would just like to say a big congratulations to the Ministry of Finance for putting together the Green Finance Taxonomy. One of the key trends that we are seeing in new as coming within climate finance is, yes, a lot of countries are putting together their taxonomies, but a big piece of work that is going on is around how do we create the interoperability of this taxonomy, so that if you imagine in Africa, if every single country had its own taxonomy, it actually may be very difficult for an investor to navigate that. So what we're looking for to do is now work with Ministry of Finance in Ghana to ensure that there's a clear interoperability of the taxonomy that's in Ghana and the taxonomy that's in Kenya to the taxonomy that's in South Africa, so that it allows investors to look at our region and to look at the priorities for the region in a little bit more of a without adding to the complexity already of international finance. The last two things I'll mention is around as a trend, or what are we doing, what else is coming, and what are we doing about it, or what can we do to mobilize more funding. I think a key trend that we're seeing is also looking at the pricing of greenhouse gas emissions or other environmental externalities. And what I mean by that is there is a cost to greenhouse gas emissions. However, as a continent in Africa, we actually have the capability to be one of the largest carbon sinks globally. And that brings about, what is the benefit of being one of the largest carbon sinks, right? As if we maintain our rainforests, if we plant more trees, if we maintain our sea flora and fauna, that actually supports the global mission of reducing our greenhouse gas emissions. And there should be both a price for more greenhouse gas emissions and also a credit for this. And carbon credits, which is a term that I'm sure you've all heard quite a bit, gives us as the continent a huge leverage in this discussion of how do we mobilize capital. And I would encourage us to actually, and Ghana has done a good job around carbon credits. And I think that the framework that's been created there, being able to price carbon credits, have a robust monitoring and verification process for carbon credits, and then bring verified carbon credits into the open market, whether it's voluntary and in the compliance market, that will really kind of mobilize new capital for Africa. And, this is capital that our SMEs, would be able to tap into without necessarily requiring collateral, right? Because it's it's impact based. It's based on actions that they would be involved in. Whether the action is in agriculture, ensuring that there is regenerative agriculture and greater soil health. The impact, the credit out of regenerative agriculture is based on the actions that they have, and it's not based on the collateral that they have. And this kind of would change the dynamic of financing for a lot of our small, medium-sized enterprises. I think I'll stop there for now.
Great. Thank you. Thank you very much, Dio. I think that's really very useful. Let me quickly mention that we've put in the chat box the feedback forms in terms of how beneficial this session has been to you, what practical takeaways did you have, and also how we can improve this events going into the future. So please take some few minutes to complete that for us. We do have a few questions, some of which I believe have been addressed. So, for example, Samuel Kojo Daku directed his question to Ministry of Finance. He said, please, developing a climate finance taxonomy is a step in the right direction, but certainly not enough to channel more funds for climate purposes. So please, could you share any other mechanisms that government has taken to incentivize finance flow from the private sector to the climate purpose? I think that was quite embedded in the question I asked in terms of policy options to incentivize financial institutions, but also broadly incentivize funding and finance for this purpose. So again, from Samuel Kojo Daku, more to BOG. How has BOG been able to embed climate indicators in reporting from financial institutions to the regulator? How has BOG embedded climate indicators in regulatory reporting by financial institutions to the regulator? I think that may be something that Stephen, you can address maybe in your closing remarks. And then we have a question from Aziri Imoro Abdullahi. In all this competition, what can financial institutions do in terms of compliance and competition? In all this, what can financial institutions do in terms of compliance and competition? I do note that some of them have been broadly addressed, but if any of you want to take a more specific response to any of this, I would allow a few minutes, maybe 1 minute for that. But I do see a hand up from Joseph Donko. Joseph Donko, you may ask your question now, and then we can get some closing remarks to the others that have been. And then I see Abena Asari Mafu, your hand is up as well. So we'll take a few comments and a few questions. So the first person, Joseph, please go.
Okay, sorry. Good afternoon.
Good afternoon, Joseph.
Okay. I heard Mr. Dio commenting Ghana on our efforts towards green sinks. That's the planting of trees to ensure carbon sequestration and stuff like that. I believe that we should make sure that the requirement also includes the menace of illegal mining. It should be holistic, because once you commend us for the carbon credit without taking into consideration the impact of the credit of the illegal mining, this same illegal mining goes around to cut down the trees that we have planted. They enter into the forest zones and cut down the trees. So they plant the trees and go back and destroy the trees for illegal mining. That is what I want to say about the balance. Thank you.
Thank you, Joseph, for pointing that out, that the approach should be comprehensive. So thank you very much, Joseph. Abena, please, you have your hand up. Please go. So Abena Asari-Mafo, please unmute and speak. I think you're still muted.
Yes, thank you very much, Robert, and good afternoon to everyone. I think this has been a very insightful session, and I really appreciate what has been discussed. But my question goes to Foster from Ministry of Finance. I know John mentioned at a point that the use of data is highly recommended. I just want to understand from the Ministry of Finance's point of view, how are you, what KPIs are you using? And how are you using data to also measure performance so far? Because from the discussion, I see that we've done something, but there's a lot more to be done. So how are we measuring performance in terms of climate issues in the country? Thank you.
Great. Thank you, Abena. How are we measuring, what KPIs and how are we measuring same to determine our performance in this direction? Thank you. Thank you very much, Abena. Bridget Kaminta. Bridget, please, you have the floor.
Thank you, Robert. Good afternoon.
Good afternoon.
I think this question would be directed to the Minister of Finance. As much as banks are responding positively to the ESG call, what policies are we putting in place, or what policy have we put in place from the licensing of corporates when they come in to ensure that they conform to these sustainability goals? I am asking because if banks are supposed to be lending out to these corporates, we should ensure that they are conforming to these sustainability goals. But I guess that if we are able to track it from the entrance level, it will help all of us. I just wanted to know, are there any policies or strategies that are used at the entrance level to ensure that they conform even before they start operations? Thank you.
Great, thank you. Thank you very much. And perhaps we'll take one more and then we can get a response, closing thoughts from our panel members. Mr. Clifford Metal, former president of the Institute, you do have the floor, my president. Please, if you're mute for us, and then you can speak. So, Mr. Metal, if you are speaking, we cannot hear you because your mic is still muted. All right, so it appears we may have a challenge with Mr. Metal's line. So can we get some responses to the questions that have been asked more from due in terms of the fact that we are planting trees, but we going right back to cut them, you know. So, and then of course from Abena, the data element in terms of what KPIs and how we are measuring same. And then again, and I think, Bridget, your question may be more to GIPC, right, in terms of at the point of entry, corporates and investors coming to this country. What do we demand from them as they set up shop in our country? So, who wants to pick this? Maybe let me go to Foster. Foster, if you're still with us, if you have any quick responses, please.
Yeah, thank you very much. If you can hear me, thank you very much for again for the opportunity and the question that have been asked. I just want to say that first we would have to work together. It's a great area for all of us. A lot of the things has been done in a traditional way. But moving forward, we need to do things different. So that is the first thing. And therefore, working together is very important. In terms of policy, initially, I indicated that there is the need for policy coherence and also integration of policy. So we need to look at all the policies that we have again, vis-a-vis energy, mining. We need to be looking at sustainable mining. We need to be looking at the renewable, and also that is why we have the new framework in terms of the energy sector and all that. So we need to really look at a lot of these policies again. But having said that, in terms of measurement of performance and all that, we're looking at, from the Ministry of Finance perspective, we're looking at the overall inflows and also how it's coming in and all that. But it will be good to go a little bit further. I know the central bank already is looking at the financial sector performance and all that, as Stephen did highlight. But beyond this, we're looking at the MRV, looking at emission where the EPA will be looking at emission monitoring of emission verification and all that. Whilst the Ministry of Finance look at the MRV finance and all that. Based on this, we've set up a Climate track to be able to do the internal monitoring of inflows within country and external sources. Beyond that, we're looking at how we can have a dashboard at a glance. You'll be able to monitor at a glance inflows and see how we are performing as a country. So in terms of maybe the performance, this is what I want to say. But beyond that, we also have to look at how maybe periodically we can assess this inflow as against the targeted and projected for the country. In terms of licensing and all that, I believe already there are laws in place. Currently, the EPA law is being amended, and it has components to ensure that licensing or institutions that have been granted the opportunity to operate adhere to what is in the country's regulation and all that. So these are then in terms of doing this, already there's this environmental assessment that is being conducted before institutions can operate. But over the years, enforcement has been a challenge. That is why the Ministry of Finance gave the EPA opportunity clearance for them to recruit additional staff to be able to have their legs on the ground, to be able to do the groundwork and ensure that it's not about submitting documentation for environmental assessment. So currently, EPA has been provided a human resource capacity to be able to do that. The EPA law is also being amended. It's one of the things that is being considered at Parliament currently, and we believe that if there's any window for our parliamentarians to sit, it will go through. It's a requirement, it's a KPI under our engagement with our partners. It's a KPI as a country for us to be able to deliver on our mandate. I think these are basically what I want to say. I'm sure others have would add up. Thank you very much.
Great. So thank you very much, Foster. Gio, I think you've responded to, well, there was something on the carbon side. Maybe let me take this as closing comments. We are about maybe 15 minutes past the hour. So 1 minute to summarize this from your perspective. Today we've been, from Challenge Your Bankers perspective, this thought leadership is important to bring some awareness to the conversation. This is an important conversation. For us, it's about resilience in the financial system and how we navigate the horizon risks. Moving the conversation from not just compliance and risk management, but also to opportunities. So, and this falls broadly within our mandate of to educate and to regulate the banking profession in Ghana. So on that note, thank you. Please, those who are completing the forms, we actually encourage all of you to complete the feedback forms for us. That will help us improve upon what we are doing. I have a few more questions that have come through, just that maybe you can take them as part of your closing comments. How effective have green bonds been in driving climate finance, and what challenges remain in expanding their use across global financial markets? That question came from Daniel Ofolikwe. Is it Ofolikwe? And then very insightful conversation. So far, the resource persons have made it very practical in terms of your submissions, and you make it very easy for us to understand. So that's a thank you today. And then there's a question from Benjamin Akum Selia. Sorry if I didn't get the name right in terms of pronunciation. How can an oil marketing company raise funds or assess climate funds? And that's a question from Benjamin. So closing, there's a question from, or a comment, Mr. Metal. Can we have the recording of this? Okay, sure, that's noted. And then there is another question. ICC Global Banking Commission has launched the ICC Principles for Sustainable Trade Finance, capturing green trade finance and guidance on sustainable linked supply chain finance. Do the panelists have any links with them? Does ICC, does any one of us here have a link with ICC, I believe? So I'm going to just give you 1 minute to please wrap up for us. Let me start with my good friend, John, KPMG Africa. 1 minute, please. John, you're muted. Great.
So I'll just highlight maybe some of the questions, and so basically my job here at KPMG is to work with governments and private sectors and financial institutions to help them design, issue green bonds and funding instruments that they are willing to unlock funding, and also help that bridge that 700 billion US dollars that you were talking about. How do we bring the money home? So that's my job. So I work with a group of team here in Nigeria as well as across Africa to make that happen. There are opportunities with the oil and gas. If you realize that oil and gas companies are now moving into energy companies, and there's a reason why. Is to take the opportunities of renewable energy and also enter into a space where, whilst there's a switch from fossil fuel to use of electric vehicles, they can also tap into the opportunity to be able to establish ports where they can recharge vehicles. So there is opportunities everywhere. You just have to find what works and what can be used by your business. So yeah, so that's in 1 minute, right, Robert? Thank you.
Thank you, John, for actually being very efficient with your time. Thank you very much. Let me go to Stephen.
Yeah, Robert. I think let me touch on. I saw these two questions that were directed to BOG as to whether BOG has incorporated some climate indicators into reporting framework and other financial institution report to. I think somebody asked that question. And then one, how can BOG assist financial institution in sourcing finance? That one too is also there. Let me just quickly touch on that. In respect of the climate indicators currently, we have not come up with any prudential requirement yet. Of course, in respect the IFRS S2 disclosures, financial institutions under metrics and targets, if they have set some target for themselves, can disclose that in their financial audited statement for the investors in making decision. Of course, these climate indicators is to see how best we can achieve the net zero agenda of 1.5 degrees Celsius global warming. And of course, based on what the IFRS has done, we in our reporting asked them if they have set those targets as part of the transitional plans. Of course, they can let us know, but we have not set any potential requirement on that yet. Number two, the other question somebody asked us, BOG, how can we assist financial institutions to attract these global funds or to sourcing some of this fund? What we do is that we build in the capacity and we collaborate with key stakeholders like I said, CIB, the IFC, EPE, and all the other key stakeholders to build the capacity of this financial institution in meeting the requirements. Number two, I also said that there should be a robust and that enabling environment that will whet the appetite of these investors and also to attract. And we need to incorporate these requirements of these funds into our regulations. That will boost the confidence of the investors. And that will also help for our institutions to meet the requirement. If they are not in regulations here, they will not be able to put the systems in place, the robot framework that they will need to put in place to ensure that things are happening or are reflecting on the ground. Because at the end of the day, to attract the funds, things must happen on the ground. They must see that you are really doing what you say you are doing. It's not just joke like that. And that is what BOG is doing. Probably let me wrap up just use 30 seconds to wrap up. I want to say that we thank the CIB. I think what we are doing really form part of the strategic plan of the supervisor. We want to create more awareness in the system. Whatever we do, the climate issues have come to stay, and there's a need to build a capacity and create awareness for everyone to be able to work and contribute. We need to build expertise to be able to address this risk, and therefore, for me, this form part of the capacity building in the system that is required. The issue of data, of course, that the John touched on is key. We understand that is a key issue because if you take the risks part in addressing the risks, you need data, you need quality data on exposures, data on all the other issues that we have discussed, so that the financial institution should be able to measure the risk and address it appropriately. And that currently is a challenge. And that is that. I think the good thing also, which has happened to us, is the issuance of the green taxonomy by the Minister of Finance. Of course, the work of all of us and other key stakeholders to be able to come up with that, which is key for us. That is also going to direct some funding to certain sectors. Of course, depending on how the investors are going to also look at that. So in all, I think it's good. I would suggest that we keep on doing this from time to time to build a capacity and to create or to raise the awareness and to ensure that we do our best. Of course, although our contribution when it comes to the climate, like the IFC resource person said, are very slow, the impact on our economy is so huge that we need to take the appropriate measures to ensure that we are handling things very well on a going concern basis. On that note, I want to thank you from the perspective of the Bank of Ghana for inviting us to this table for this engagement. On behalf of the governor and SDGs, we say thank you so much and good to the CIB. Thank you.
Thank you very much, Mr. Stephen Ama from Climate Unit of Bank of Ghana, BSD. Thank you so much. So, Foster, any closing comment from you? 1 minute if you'd wish to take that, and then we can go to Dio.
Okay, thank you. As Stephen and others have indicated, I think the most important thing is look at a brighter future that is ahead of us. We've all started on a good note, especially with the financial sector leading this charge of creating awareness and also building capacity along the line. We should continue to work together as government and private sector, especially the financial institution. The most important thing for us from the Ministry of Finance is to be able to mobilize the needed finance and to implement the actions that have been spelled out in our NDCs and beyond. I'm saying beyond because we're looking at how we can become prosperous beyond the NDCs that we have developed and also submitted to the UNFCCC. So beyond that, we've developed the climate prosperity plan, and we believe that we need to incorporate, and all of us need to come on board to be able to get this agenda going. And I believe that even though climate change has become much prominent and is increasing day in and day out, we will be able to become resilient and be able to reduce the impact of climate change when in the nearest future, and also with the current situation that we face. So thank you very much, and God bless us all.
Thank you so much, Foster. And so I pivot to Dio for 1 minute, please, or less, if you can.
Thank you very much for this opportunity. And I think the progress is great. The green instruments have been a major catalyst for targeted investment to address climate finance. If you look at the growth since 2020, we're now reaching about cumulatively over 5 trillion, 4 trillion of issuances that have happened since 2007, when really the first funds that were targeted used towards climate change came into play. So the growth is great. I think Africa still has quite a ways to go to really mobilize more capital. But the positive thing is, in discussions like this and in convening and building capacity, more bankers, more financial institutions are going to be the catalyst towards making more of our financial flows really address the needs for Ghana and for the continent. And lastly, what I would say is, beyond just mitigation, I think for the continent, the more we can focus on adaptation and resilience, and looking at key sectors for our economies like agriculture, we will really be able to bring more than just addressing climate change, but also addressing a very important part for the continent, which is the social aspect and the social impact and the vulnerability that goes along some of the challenges that we're looking to address. Thank you.
Thank you so much, Dio, and thank you to Stephen. Thank you certainly to John and Foster for really providing expert points of view on this important conversation that has just happened. We are extremely grateful to all our audience who have joined us on behalf of the Governing Council of Chartered Institute of Bankers Ghana. We are extremely grateful to all our stakeholders and all the audience who joined us this morning. To our sponsors, so lead sponsor GCB Bank, GNPC, Fidelity, Prudential, Kwelman Rural Bank, and Casapreco and others, we are extremely grateful. At Chartered Institute of Bankers, I go back to our mandate, which is to promote banking education and regulate the practice of the banking profession in Ghana. That means developing trusted professionals. That means actually bringing perspectives like this to yourselves, our members, students, fellows, and other stakeholders. And we are extremely grateful that you have joined us this morning. The rest of the activities in terms of the Bankers Week activities continue on the 21st of November. We do have the National Banking and Ethics Conference, and we invite all of you. We do have other events that are coming up, the Governor's Day as well, which is I believe on the 21st of December. So we look forward to seeing you at the next event. Thank you very much for joining us this morning into the afternoon. So Let's have a good day wherever you are, and let's make sure that we use resources, but also ensure that we don't compromise the need for others to benefit from same resources in the future. I think climate issue or ESG issues are generational issues, and let's do our part and find practical solutions to some of the nagging challenges that we have. On that note, thank you very much, and thank you, John. Once again, thank you, Foster, thank you, Stephen, and thank you, Dio, for joining us. Have a good afternoon or good evening, wherever you are. Thank you.
Thank you very much. Bye-bye. Have a good afternoon too.
Thank you. Bye. Bye.
Thank you. Good.